Anand Tandon joins in to talk about the markets and what he's made of all the triggers so far. Anand, hi. Are you expecting the flow situation to continue from here on? Because there's so many, reports doing the rounds trying to find out what the nature of these flows are. Where do you think it's coming from, and how much do you think it could prop up the markets from here?
Well, it's difficult to say where it's been coming from. I'm sure some of the institutional brokerages will be better qualified to answer that. But clearly the money is there, and even the domestic liquidity is much better than it was a few weeks ago because of RBI's action. So for now, I don't think that there is any major problem on the flow side. And as we've been maintaining, I think the market was pretty much pricing in most of the negatives. Not that anything positive is expected to appear from here on suddenly to miraculously change the environment, but I don't think that there is much danger for the market in the immediate near term, barring any major catastrophe in the overseas world. So on the whole, I would think the market continues to look reasonably positive.
Anand, what have you made of the 6.87% inflation reading that we've got? Are we likely to see more of these sub 7% inflation readings, or this one is an aberration? And are we likely to see a rate cut perhaps on the back of a lower than expected inflation print?
I think one figure is it's too early to see whether or not it will change. I think it was already expected that you'll get a lower figure because of the high base. But that said, I think the latest RBI survey of households has again indicated that the expectations continue to remain at above 10%. And the CPI also continues to remain above 10%. So with that kind of inflation figure, at least at the consumer pocket, I think it will be difficult for the policymakers to actually argue for a rate cut.
So what do you think the returns could be from the equity markets by the end of the year? Because give and take everything, we've performed better than most of our Asian market peers. This year we're up about 15% year to date. Do you think we'll have to resign ourselves to a range for the next 3 or 4 months, or do you think there are better returns in store?
Well, I think we still probably another 10% from here till the end of this calendar. I don't see any reason why that should not happen. I'm not expecting any major policy action from the government, so I'm assuming that other things remaining the same, that's where we will be. If we do have certain kind of aggressive policy action, maybe there will be a sense of euphoria in the market and it could be higher than that. But frankly, I think that's not something that you can game.
So to capture this possible 10% upside that the Indian equity markets could offer, where would you recommend fresh investors to park in money? Because high beta is, there is no guarantee that growth will come in at good levels, and something like an FMCG is at very high valuations.
Well, it certainly is, and I think the sectors that have not so far perhaps or have somewhat underperformed would be the areas that you'd look for. Many of the institutional investors, for example, have been underweight IT. I see that, as you mentioned, FMCG, etc., is perhaps too overpriced. So while it may continue to deliver good results, it's unlikely to give you similar upside on the markets. So consequently, you're still looking for companies which have reasonable ability to deliver results, but at the same time are not pricing in all the euphoria, and it has to be somewhat cyclical. So, perhaps you are looking at banking and IT and to some extent healthcare, and at some stage I would imagine, the consumer discretionaries also would be something that would participate in the rally.
When you say banking, what do you mean? Because after looking at SBI's numbers, I don't know how many people on the street would actually have the conviction to go ahead and buy PSU banks, at least for the next couple of quarters. How would you justify the buy there?
So, banking figures are what you want to make of them. At the end of the day, if the SBI is actually reporting numbers which are down, it's actually great because it means that they are being honest about things. Those who are not reporting bad numbers actually just means that they are postponing the inevitable and hoping that the business cycle will turn. So frankly, I don't think I would worry about NPA numbers or anything of that sort unless there is a structural problem, which there is, because if you look at it, most of the NPAs in the industries, or a large part of it comes from a smaller segment, which is the rural area, and that is what RBI has been unfortunately pushing to grow. Perhaps under government pressure, the priority sector lending norms are becoming tighter. But that said, in banks you don't really worry about the balance sheet, you just look to time the cycle. And I would think that it is time now to look at a cyclical uptick from here in terms of the economy, and therefore the NPAs will work themselves out.
So that,
What would you do with something like Tata Motors now after looking at the results and the movement in the stock?
Well, as I said, the consumer discretionary space is something that I think would kind of turn around in a few days, or in a few weeks. But Tata Motors has to worry about a little bit about its international presence, which is where the dominant numbers are coming from. And that is something that we really can't take a view on sitting from here. But if you look at what's going on in Europe, it doesn't look very easy to play. So from a market point of view, I think Tata Motors should be perhaps on the way up. But from a fundamental point of view, I think you may find that there are still some issues to be sorted out there.
Anand, what's the market and the fundamental view on Tata Steel as well?
Well, steel is something I have never really particularly liked, given the slowdown that one was witnessing in China, and I don't see that that is going to change anytime soon. We have seen metal space in general and steel as well suffering, therefore, therefore the results are not very surprising. Again, a lot of exposure in the overseas market doesn't give you too much support. At least if you were dominantly in India, one could argue that there would be an economic upturn fairly soon and you could actually benefit from there. But with being a global commodity, I think we are in for a little longer pain period there. So between the two, if you have to choose between motors and steel, I would prefer motors. But steel, I think, is something that will continue to drag.
So Anand, for an average investor, what is the next trigger according to you for the market? Because we're done with earnings season, we're not expecting too much out of the policy, and even from the global markets perspective, Europe seems to be in limbo now with no action coming from the ECB yet. What is the next big trigger that you would watch for?
Nothing really, and that's the best part of it. You shouldn't be looking for triggers except if you're a momentum player. It's when the market is really boring that you get to make some money. But if you're really looking to see, for example, economic news is likely to continue to remain negative for a while. And on the other hand, there may be some likelihood of policy action given that we now have a new chief economic advisor. Nothing that he has said of late, of course, shows you that there'll be any new thinking. But again, I would imagine that we renewed pressure on some kind of move to allow FDI to come in various sectors and to increase, hopefully some disinvestment and so on. These are things which tend to excite the market, irrespective of their actually underlying economic benefits or otherwise. So from that point of view, those may be the things that may actually drive the market. But if you really look at the economic news or the corporate news, I doubt very much that you will see anything which will be very exciting.